Vahan, welcome to Cultivated Live for Thursday, September 18th. Thanks for being here.
Thank you so much. Thanks for having me.
Well, we like to talk about good news, and you've had some good news. High Tide's Q3 earnings came out. Give us the thumbnail sketch, and then we'll dive in.
Yeah, so it was by every metric, our greatest quarter to date. And, no matter what you look at, it was either a record level, which almost everything was, or it was the fastest pace of growth in 2 years or 3 years. It's really the culmination of all the work that we've done over the past several years that actually got all the pistons firing and then producing these fantastic record-setting results. And it's great to see the market validating and really rewarding the strong work that our team did.
Yeah, and it's partly, obviously, we get the press releases about new store openings. We talked to Raj about that, and same store sales, I imagine, are part of that. There's a song that me and my kids love called "A Little Bit of Everything." It's a little bit of all those things, right? It's the stores doing well that have been open. It's net new stores opening up. It's there's been certainly news on international fronts. Like, is that what investors are responding to, or is it all of it?
Yeah, I think that's exactly what it is. It's the blocking and tackling, right? It's in the last 12 months, we opened 24 stores. And despite that, we had 8 million almost in free cash flow this quarter, right? Same store sales at 7.4%. That's higher than previous quarter, which was higher than the previous quarter. So what that shows is, the existing sort of mature multi-year stores are generating increasing sales. And the new stores that are now entering after 12 months, entering that comp set, are doing fantastically well. And as much as it's a record quarter where it's a $600 million revenue run rate leaving the quarter, you're also leaving at a 2-year high of the existing stores. And we've got another 20 to 30 stores coming in the next 12 months. So it's really sort of at the point where you have that leverage, it's feeding off itself, and you're seeing it in the free cash flow. And then obviously you add on top of that the acquisition of Remaxion, which was not in these results at all.
Right. And I want to talk about those stores that have been open and the new ones opening, right? There's a bit of, certainly in the first tranche that opened years and years ago, getting those ramped up, how to make the operations, a certain flywheel, even keeping products on the shelves, because the market outside of your control was the cannabis market was wacky, right? The provinces were getting, right. There was just a lot happening, right? With product variety, edibles, and some products not coming online for some time. Like, it has the time to make the store sing. I don't know what the right term is, but has that also shortened, right? A new store, you're talking about 2 stores a month opening up. Has the time horizon for those investments to get that store open, has that horizon shrunk?
Yes, it depends on what frame you're looking at. Obviously, in the beginning days of legalization, you were the only store in town, and everything was great. And then you reach a point where there's way too much saturation, way too many stores in one downtown cluster or small towns, etc. And then we launched a discount club model, right, a few years ago. At that point, I knew the stores were just taking off, given the advantage that we had. And in the last kind of year or two, stores are taking longer to ramp up. Just because now when you open a new store, you're no longer the 3rd store in town, you may be the 7th store in town.
Right.
But what matters for us is, especially given the strength of our brand and the strength of the real estate, we always make sure we get tier 1 locations. Even though it may be taking a little longer for new stores to ramp up today versus, say, 2 or 3 years ago, they are ramping up and they are becoming winners, right? So one of the best sort of examples we like to give of that is Sherwood Park, Alberta, where about 2.5 or so years ago, as a test, we launched a new store into what is, I believe, the most saturated market in the country. And we saw is because we got the best real estate, as a test, we said, what happens to that store? And it took longer. It took over a year to get up to full maturity. But now that store is an above average Alberta store for us, which is about double the peer average in terms of revenue. So that really validated our thesis that given the strength of our brand, if we can leverage that with the best real estate in a certain area, our stores may take a little longer, but they will all be winners. And now our 200th store, about 2 or so months ago, was also in Sherwood Park, Alberta, our 2nd store. That's how much confidence we're getting to be able to open stores, as long as we get the tier 1 locations, which we do, given the relationships we have with our landlords.
Yeah, I want to talk about that, because I look at other markets in New York and New Jersey, like the states that open up in the U.S., and the locations become almost like whatever you can take, go get it, because the landlords they don't want you, right? The cities generally don't want you. The landlords don't want you. They look at it as a big risk. And I asked Raj the same question. I want to sort of ask you is, like now I assume there's inbound calls from brokers as opposed to outbound calls from you where you get hung up on. Like that changes the dynamic considerably, not only for you, but for the rest of the market too, where on our high retail streets in Canada, we are now, or you are now, like welcome, wanted, good tenant, an important part of that street.
For example, yeah, as I think Raj may have mentioned on a previous interview, the new location at the Well. I mean, tier 1 location. It was an inbound to us, right? But and that really shows our strength and our relationships with the landlords. But and generally, the entire market has improved from the earlier days of legalization, where you couldn't get a lease or you had to pay these huge cannabis premiums, which we never did, and that's why we're still around, and many of our competitors aren't. But I wouldn't say that necessarily this sort of inbound rush is coming to other cannabis companies. I mean, we're very unique in the relationships that we have with the leading landlords.
Yeah, there's many case studies in that for operators in Canada for sure, but outside of Canada to say, do it right, grow responsibly, even if aggressively, and be a good operator, because the locations may not be there on day 1, but day 300 and 1,000 they will be.
Yeah, and these 4,000 square foot stores in the beginning, I mean, you may have made lots of money when there were 25 stores in all of Ontario, but in the long run, if you can have a real business, you need the best locations. You need to have good revenue per square foot, good inventory turnover, all the nuts and bolts of retail that Raj and the team has been doing since 2009.
You said 4,000 square feet. You're not even naming names, but anybody who's got their ear to the ground of what's happening in Canada knows of what stores you speak or what stores you spoke about. And so what is ahead? I mean, is it blocking the tackling still? Is it growing in international markets? Is it honing the operations, or again, a little bit of everything?
A little bit of everything, right? I mean, last year the target was 20 to 30 stores. We opened 29, 28 built, 1 bought. This year the target is 20 to 30 stores. We got 16 already open. Probably have another 3 by the end of the month. A dozen or so under construction. So we should be at the high end of that range once again. And next year is probably more of the same. So we're optimistic that we can, especially with a higher share price, we can get some M&A under our belt, which has been slower of late. Otherwise it's the slow and steady march from 207 stores to the goal to exceed 300 in Canada. And simultaneously now, the next leg of growth is Germany and Europe with Remexian. Obviously, that just closed 2 weeks ago, the first 51%. So that opens a whole new leg of growth for us internationally, not just domestically, where things are looking great.
Well, we appreciate the time you took today. We appreciate Raj's time a couple weeks ago. And kudos on the great Q3. Always good to have good news from publicly traded cannabis companies to share with our audience, but also just hear what it takes. I think, again, there's lessons to be learned, but even the numbers you're talking about, 207 to nearing 300, like those are big numbers for any kind of cannabis company. And I don't know if you sort of have a chart on your wall of where other big retailers in North America are, but that might be one of the biggest, don't you think?
One of the biggest, and we're consistently one of the fastest growing retailers across North America, and several rankings that we've already got appreciation and recognition for.
Yeah, it's not easy.
It's not easy, and it's also not easy to do it while you're still making money, right? We still made $17 million of free cash flow, even opening up all these new stores that are starting from scratch on day 1. And there's 2 dozen of them in the last 12 months, and there'll be another 2 dozen in the next 12 months.
Well, we're not going to talk to you every time a new one opens up, but maybe every 3rd or 4th store, we'll make it a regular feature to find out where they are and find out how it's going.
Happy to chat anytime, Jay. Thank you so much.
Thanks, Vahan. We'll talk to you soon. Thanks, everybody. We'll see you tomorrow.